Today is November 30th, and this is Will, and we're gonna look through simply VIX and Fear and Greedy Index and house price and mortgage delinquency rate and unemployment and U.S. bond spread. First one is the VIX, and now today is 21. So as you see here, around 21, and 1 month ago it was over 35. And when we go back to March this year, it was, I mean, February this year, it was around 15. So the VIX number go to the around 15 again, then we can expecting the market going up like 2019 again. But the number is just stay here or when go up, then we can expecting another correction from the market. So we need to watching out the VIX with market. Okay, and next, the second one is the fear and greedy index. So up is the extreme greed and lower is extreme fear. So today it's around the close to the 100. So as you see the here 2019 it was close to the 100, and then the beginning of the 2020 we have a little bit corrections, but after pandemic spread more and hit the US and worldwide, it plunged down to the almost close to zero. So when we have some issue, we can expect it suddenly plunge around this level again. But if some issue hit the fundamental, it can going down to the zero possible. But most experts said big numbers stay around here, with, and then they expect is until um, until means the 2023, which means the Fed start to maybe that time increase interest rate. That time and something hit our fundamental, then maybe going down again. But until that time, so which means the Fed interest is close to the zero, then we're gonna stay here. And this one is the house price index. So that means the around uh, 2000 house price was 100, and as you everybody know that the around the 2008 we have a subprime mortgage crisis. At that time, house price is over 150, and today 2020 it is 200, above 200. So from here to say it's a recovery of the house price here around here is because of the 2008 Fed did a lot of the QE, quantitative easing, right? So which means that they printed out lots of money. And 2020 Fed another large of money printed. That means we say QE. That's why it causes inflation or boost the house price again. That's why the house price go up. But in case like this time downturn happens because the subprime mortgage crisis caused the house price going down a lot because of the house poor. So it can happen. It can be happen here possible in the case the house price going down. Another one is the house price kind of supported by the government policy. So when another policy come out to stimulate or support the U.S. economic, then it go up and needs it go sideways. So we need to watch out the house price and then the government policy, financial or treasury policies. This one is exactly talking about the mortgage de-linkage rate. So green, I'm sorry, blue is the 30 to 59 days mortgage payment past due, and red here 69 to 62 to 90, 89 days. Green here um, over 90 days mortgage payment past due. So 2008 fourth quarter, when you see here, the mortgage delinquency rate going up, and after the subprime mortgage crisis, then it suddenly go up more, and because of the Fed's QE and lower the interest rate, and so they buy lots of the MBS. That's why the interest rate going down again. But here again, 2020 second quarter, so it is again to 8.2%, which is almost like 2008 fourth quarter. So this rate expected to go up again without financial support from government. So next one is we talk about employment rate. This one is the initial jobless claims. So here is the 2020 March. After pandemic, is go up high again, not rocket high. So it hit 6 million jobless in a week, and it keep going down, and now it's around the 700,000 to the around that level. Okay, and next is like, okay, let me erase this. Okay, when you see this number, see this one, non-farm payroll employment. So people lost a job a lot, and then after that, their recovery, but recovery rate is keep going down. And employment rate was the hit 14% around April, and then keep going down, but it stay around the 6 to 7%. And exactly November 12th, unemployment rate is now 6.9%. But we cannot expecting it going down again. Probably it goes sideways, because the some people say second or third, fourth pandemic wave hitting U.S. and Europe hard. So that's why, and so it means it's hard to back to the normal life or previous life of the pandemic. Is not easy or delayed a very long time. And as a last, this one is the 10-year Treasury constant maturity minus 2-year Treasury constant maturity, which means the U.S. Treasury bond 10-year yield minus 2-year yield. That's the meaning, okay? And here the gray area is the recession area, like here and here, and this is a 0, so which means the 10-year minus 2-year is a 0. So today 10-year yield equal to the 2-year yield. And then the minus area is at that time the 2-year yield is higher than 10 years yield. So, okay, well, let me close the erase this first. Okay, so and we are here. So this curve is showing before we have a recession, it shows a minus. So we have a little bit short period, but we saw the minus here, and now it's in the recovery period, so it keep going up, right? But as you know, this yield spread around 1.5, then the probably Fed start to increase the interest rate. That means the mortgage rate and other debt rate gonna be go up. So we have a lot of debt, especially the government, the house, company, everybody. So in around this time, the Fed start to increase the interest rate. That means everybody need to pay more their interest to the bank. That means the economy gonna slow down, and when it spread to go up to the 2.5 here, then we're gonna see the economic shrinking again. So as long as this period, we can see the recovery time, which means the more safe for the stock investors. But from this time, we need to start to increase the bond stake in your portfolio. The investors, we always looking for the higher return, right? And then when you have a higher return, then we are looking for higher and more return. So depending on the stage of the economic cycle, it shows the typical signs. So we talking about here late stage of economic cycle. So late stage means when you see the economic cycle curve, this one is the expansion period, the other one is the contraction period. So late stage means we may be around here. So in the late stage, or you can see the close to the late stage, people have less fear and more greed, and they put more money in the market. So which means that we have more money, enough money in the market, and it increased the trading volume. So the stock market going up, and we're thinking this going up forever, but actually that is around this time. In that time, companies have a lot of money too, and they do the buying smaller companies or mergings, acquisitions. That's we see more. That's M&A, and the companies spend more money for M&A. That means when they buy those companies, they have more debt, or they using their cash, which means they cannot grow. It's hard to grow in a few years because they spend money for that. So that's M&A, and especially when they spend more money, which means that they buy another company in expensive price, then it hurts that company more. So in the news, when you see this time merging or acquisition price is higher than in decade, something like that, then it's a sign of the late stage. Another sign about the IPO, usually IPO companies, they, the ones they come into stock market, their price is moving slowly, going up or the sideways, depending on their revenue growth or profit growth. But when lots of money in the market, then people betting on the company, the new companies, then their stock price going up suddenly, like the market price. And the other, the investors, they followed that trend, and then they put more money in the new company, and then price keep going up like that. And then suddenly at a certain point, they see that, oh, the company has a nothing, it's a bubble, no revenue growth, no profit growth, then price going down suddenly. That causes crashes. That's the late stage sign too. Recently, we see the new IPO companies, and without the balance sheet support, which means the revenue or profit growth, price keep going up. That means though it increases the possibility of a crash down. And on the next thing is the house price. Larger money and the low Fed rate, that means the good time to buy a house. So house price go up, and the people feeling good, market price going up. But later on, as we see the mortgage shrinkage rate going up, then people start to sell more house, then house price going down. But at that time, market thinking maybe this one is temporary, so they still going up. Later on, house price keep going down, and finally market crashed down. So that's the story of the late stage of an economic cycle. So before this, now is the we can say this moment, but probably December or January we probably see this kind of conditions. So we should be careful about the market. So that's why we're talking about those five numbers. Okay, let's recap. So uh, the, the what we watching out: VIX and Fear Greedy Index, house price, mortgage shrinkage rate, initial jobless claim, and unemployment rate, and then at that time market going up, down, or sideways. Oh, I forgot one thing more. 10-year and 2-year bond yield spread, right? So we need to watch out this, and then how to market responded that. And another thing is the Fed and government, they making some policies for us or not. That's the how we respond to the market, or how to control our portfolio kind of things. And then always the one golden rule is to invest is the find company making good profit and increase revenue every quarter. That company is the best company, even though when we have a crisis, the stock price going down a little bit, but short time they're gonna recover and then rocket up again. Okay, that's all today. Thank you. Love once more. Thank you twice.